Well, good morning, everyone. Mickey's got his big hand on the 12 and a little hand on the 10, so I guess it's time for us to get started. Thank you so much for being here. We've got a lot going on in the world and lots to cover, but we really appreciate you being here. As usual, we hope to give you a general overview of the key issues impacting the U.S. and global economies. We're focusing on those areas that will impact most of our attendees, and we have a very diverse group so far, and plenty more signed up to be on in just a few. You'll note the chat box on your screen. Feel free to enter any questions as they appear during the session. If your memory will work for about 35 or 40 minutes, fine, wait and type them in the end, but feel free that if it pops in your head, enter it in the chat box then, and we'll be sure to address it as we get to the end of the session today. Well, let's review a quarter of continued growth, change, and uncertainty. Uh, I'm a little surprised by all the uncertainty, as I'm sure you are, and it's just kind of like, well, this is life as usual. So we'll jump in and hang on. It's hard to believe when we had our Q1 economic update just 3 months ago, the US economy was beginning to slow a little bit. Inflation was declining, getting close to that 3% target. The feds had paused. No more interest rate increases, but no decreases. They were hinting about possible rate cut or cuts before the end of the year. We had unemployment continuing to hover at all-time lows. We were optimistic that the Fed adjustments would actually result in that soft landing that Chairman Powell had talked to us about. We're anticipating the federal rate cuts would begin right about now. So we'll talk about where we are in just a few minutes. Americans continue to spend money on fun with family and friends, travel and entertainment, even if they're having to spend a lot more than they did last year and definitely even the year before. We had two presidents in a statistically dead heat political campaign. So, what does all this mean? Well, joining us today is our good friend, Pat Gauthier. Pat, I'm going to turn this over to you.
Yes, sir. Thank you, Marshall, and welcome everyone. It's great to be back with the group again, and always appreciate spending time with you here on a quarterly basis. So, really, to start, we're going to jump right into the markets. We're looking at, year to date, as of last day or so, major indices in the market. So, kind of our usual refrain this year, if you were to end the year right now and take these returns, I think we would all be pretty happy with where the market is, well above long-term averages and certainly a robust return in markets so far. What I want to do is go ahead and zoom in to the second quarter. Kicked off the second quarter, as Marshall said, with some expectations of multiple rate cuts this year. Data came in a little more robust than expected. So you saw some data points come out that led the market to begin to reprice that thought process. So early in April and through most of May, you're looking at really what the market was doing is starting to discount the idea that we were going to get fewer rate cuts here in 2024. If you recall all the way back to January, we began the year with the market pricing in multiple rate cuts, in some cases 4 by the end of 2024. Everyone thought the economy, if we hadn't accomplished that, the economy would be in a recession and things would be going south in a hurry. But the numbers in the economy, as Marshall indicated, are showing the consumer is still strong, still spending extra money, and still out there participating in the economy. So as the data progressed through the quarter, we started to see the indices pick back up, and the conversation turned again to rate cuts, not if, but when. But okay, we went from 4 to maybe 0 down to maybe 1 or 2 by the end of the year is roughly where we finished the quarter. And markets, as they tend to do in the short term, reacted relatively quickly. We saw your tech stocks rebound dramatically. We saw S&P, Dow, and Bloomberg pick up a little bit. And a highlight on the Bloomberg there, remember that the aggregate is just the price change in the aggregate bond index. It has nothing to do with yield or coupon payments, but just the price change of your bonds there. So bondholders not only rewarded on the yield side, but got to see their bonds grow in value a little bit towards the end of the second quarter. Magnificent Seven, let's check in on the high flyers. Stop me if you've never heard of these folks. So they've been driving the market higher. What we're looking at in this chart is the market cap. And this is a point that we've been illustrating throughout the year. And it speaks to a couple of overall thought processes that are unique. One, you're looking at the valuations there, 3, 3, 3, and 2.25. That's $1 trillion market caps. I'll pause here for effect and we'll say that again. 3, 3, 3, and $2.25 trillion in market cap. So what we're looking at is a handful of companies worth 10, 11 trillion dollars out there in the market. If you took those companies on their own, they'd be bigger than a lot of countries' economies across the world. What's driving that? Well, to get a higher market cap, you have to have people willing to pay more for your shares. Simple math, the higher price people are willing to pay for your stock, the higher your market cap is going to be. And it's been a pretty dramatic run up in the last couple of years. We know it's based on AI hype, and we know that predictions of AI really fundamentally changing the world, and don't have to look too hard to find that prediction out there. If I could zoom in here, I would, but what you'll see on the right side at the very tail end, you're starting to see a pretty significant downturn in the value there. And should we be surprised about that? And my thought process is, we really shouldn't be that surprised that something would run up to such a high value and then quickly start to reverse course. We're looking at companies that received in the case of NVIDIA, a number of orders for the chips that they make. They're seen as the best chip out there on the market as far as AI is concerned, and everyone wants to buy it. So a lot of the demand that you may have seen over the next 4 or 5 years for chips was all pulled into the near term, and they're having trouble keeping up with orders. They need to make as many chips as they possibly can. Everyone wants them at the moment. But long story short, with the Magnificent Seven, they drove the market higher. If you were not invested in these companies and you just own the rest of the S&P for most of the year, you would have been relatively flat, if not down a little bit. Although here in the second quarter, as of late, we're experiencing what we call a little more market breadth. And that just means that the rest of the market is starting to catch up with the Magnificent Seven. It's a little bit of give and take. The Magnificent Seven is coming back to earth a little bit, if you will. But earnings for the rest of the world, the rest of the economy is they're staying strong. We're seeing earnings reports come in. The companies are still beating estimates, still generating revenue, still turning that into a profit, and the economy is chugging along there. And why does this matter for us in the market? Why would we look at those 7 stocks and have any concern or try to understand what this is going to do moving forward? And really what this is showing us is that this is nothing new. Your typical year in the stock market is going to have a number of ups and downs. So when you see a quarter start out relatively poorly and end relatively strongly, that's par for the course, if you will, in investing in stocks over the long run. But what I would say is invested for the long term. We're not market timers. If you know a market timer and they had success once and took their money and ran, then that's about as good as you can do in terms of timing the market. Most of us are not going to be successful doing that. We want to stay invested in profitable companies for the long term, knowing the roller coaster that we're getting on. We're signing up for a ride that's going to have some ups and downs, as this chart illustrates over the last 30 years or so. But this year is nothing new. We'll add 2024 on at the end of the year, and we'll see a dip in that year, and most likely a positive outcome for the full length of the year as well. So we're going to pause on the market and go into some of these fundamental factors that are driving Fed policy decisions and really the underlying implications of the economy overall. So what we're looking at is a different way to look at the inverted yield curve. Again, stop me if you haven't heard about the inverted yield curve over the last few years. So it's been one of the steeper ones historically, and it's also, I believe, been one of the longest running inverted yield curves. And inverted yield curve simply refers to that 3-month treasury rate being higher than the 10-year. So the short-term bonds pay a higher interest rate than the long-term bonds. Why would that be the case? Well, Long-term bonds are market driven based off of growth and inflation estimates. If you're going to lend someone money for 10 years, you want to make sure you're getting a rate of return that's reasonable to help you cover inflation over that time frame and help you actually grow a little bit in real value in the same time frame. So uh, those rates are derived from market participants. Buyers and sellers set the rates on what they're going to accept to lend their money out for the next 10 years. Short-term interest rates are much more driven by policy and the Federal Reserve. So we have the Fed funds rate, the overnight discount rate, whatever you want to refer to it as. The Fed sets that rate as kind of a barometer where they want to see short-term lending. Right now, we're in the 5.25 to 5.5 range. We do anticipate that we're going to get some cuts by the end of the year. The market is starting to price in multiple cuts. So again, the market will change quickly in the short term based on their predictions of cuts. But I think if you polled everyone right now, you'd be looking at least one rate cut by the end of the year. So why is this important? Well, every time this has happened in the past, we've had a recession at some point subsequently from that inversion. Can this time be different? As Marshall mentioned, we're looking for that soft landing. We'll go over a couple more components which show us that we're on the right glide path for that soft landing, but we don't want to make that call just yet. We want to actually land the plane before we hand out any awards. But what we're looking at here is, there's two fundamental ways that this yield curve could revert to normal. We could see the short end come down, driven by the Fed, which I think we will to a degree. And then we could see the market reprice long-term rates based on their projections for economic growth and their projections for inflation long-term. So how that combination or that recipe comes together to create a normalized yield curve is yet to be determined. It doesn't necessarily have to be one or the other. I do believe it'll be more of a combination of the two, because as interest rates come down in the short term, what happens in the economy? You see auto loan rates come down, you see mortgage rates come down, you see borrowing costs for businesses come down, and that tends to drive economic growth, which will then trickle into the long end of the curve, raising interest rates for long-term borrowing. Checking in on inflation, a couple quick ways to measure that. I know we've covered this many times, but you've got CPI and PCE. So CPI is your headline measure of inflation, and then PCE is the Fed's preferred measure. It takes a little bit more into account, what people are actually spending their money on. So it gets a little bit into, the choices consumers are making as far as substitutes and things of that nature. Good news is, and the main takeaway here is that we're trending in the right direction. We had a pretty steep drop off, high of 9% down into the 4s and then the 3 range. So looking at the PCE sub 3 is a pretty good thing there. The Fed's target is 2%, and we're heading in that direction. This last mile, I know we've all probably seen that in the news and the media. That last mile of fighting inflation is usually the most difficult. The time frame it takes to get there is going to vary depending on economic circumstances and Fed policy, but that last mile of the race tends to be a little more difficult. So I would expect to see this plateau, if you will. We're going to see these numbers flatten out a little bit. And remember, inflation is a good thing for businesses. It's a good thing for growth long term. If prices aren't rising a little bit, it's harder to pay people more. It's harder to grow your revenue. So that's why we have those targets set at 2% on a national level. We need the economy to grow a little bit and prices to rise a little bit each year. How about the consumer, the job market? We're looking here at still a large number of jobs open out there on the market. How fast they're being filled is another story, though. You're starting to see a lot of companies leave jobs out there on the market just to, anticipate the potential need to hire someone. So unemployment rate is heading back to normal. 4% range is usually a healthy range. So no surprise there. There's a lot to be made about the month-to-month unemployment claims and things of that nature, and they can tell you the direction of the trend, but really you won't see too many issues in the economy if you can keep that unemployment rate around 4%. So expectation is you'll see that rise a little bit, but you really don't have to worry until you start seeing it rise rapidly. so the pace of that unemployment rate change is really more important than the rate itself. And as you can see, they've done a good job of managing it to be relatively flat in the last 18 months or so. So if I could give you a takeaway on this chart is that I'm a little skeptical about that openings number. There are a lot of jobs posted out there, but employers' actual desire to fill those jobs is a different story. It's a harder metric to measure, but there's no requirement for you to remove a job post. You can always keep resumes coming in and try to find great people, even if you don't necessarily have the dramatic need for extra employment at the moment. So what does this mean for investors? What we're seeing here is a lot of folks at this point with rates where they are and with the market where it is in terms of new highs, folks are saying, hey, what are my alternatives? I can get some great rates on fixed income. I could buy a CD at 5% for the short term. Shouldn't I just take my money and get some fixed rates and stay away from the risk? Well, I would have you circle back to Marshall and talk about your plan and your need for growth over the long term. But I would also point you to this and say, historically, when we reach the peak of an interest rate cycle, which the market and a lot of folks believe we're there now, it's been a really good time to be invested and to stay invested over the coming months. So yes, CD rates and fixed income are more attractive than they've been in 15 years, but the rate of return on profitable growing businesses is likely to outpace them over the long term. So this is something we see a lot from clients and from the media. Is you're going to see a lot of banks out there advertising incentives to lock in some rates and not take risk. But just remember what investing is for. It's to allocate to risk assets and to grow your money over the long term. If you're looking for certainty from your investments, you want to take a step back and understand if investments are what you're actually looking for in that case. But a good chart to refer to in the event you feel that you can time the market, you think it's at the top and you want to get away from it. We're at peak rates and the market is at all-time highs, and we're still looking at pretty strong future returns if history rhymes. How about those new highs? I kind of led us into this a little bit, but a lot of folks have concerns about investing with markets at all-time highs. No one wants to go back to 2006 or 2007 and buy some investments and watch them be down in value for the next 5 years. But history shows us that over the long term, even if you buy at a new all-time high, you still have a pretty good shot at strong returns over the subsequent periods. Even a little bit better than if you had just invested on any other random day. So it's counterintuitive psychologically. As investors, we all want to, buy at the right time and sell at a better time, but you simply don't have any measurements to know when that's going to happen. So don't be afraid of what you see in the media. Financial news wants to talk about the highs and point that out quite a bit. But it's still a good time to invest if you're doing it the right way and you're selective about the type of risk that you're taking. So where does this leave us overall? The economy is in a good place. We are seeing softening in the labor markets. We're seeing the consumer be a little more deliberate with where they spend their money. As Marshall said, we're still out there spending money. We're just being a little more careful with where we spend it. And you're seeing that reflect in things like value meals at restaurants. You're seeing it in value packages for theme parks. You're seeing airlines run discounts, although the travel is still pretty busy. But generally speaking, the economy is in a good place. A lot of folks like to look at the situation we're in and say it has to be an on and off switch. The economy is either good or it's bad, and a lot of times that's how the market will react. It'll be positive, and then negative news comes out, and we switch right back to negative sentiment there. But if you zoom out and look at the long term, this is approaching a 10-year chart here. Stocks will grow over the long term as the economy grows, and even other asset classes. You have real estate, you have gold, compared to the CPI there. So this is our proof in the pudding, if you will, of wanting to stay invested for the long term through market cycles, through ups and downs in the short term of the market, and invest in growth assets. We believe it's the best way to build and maintain wealth for the long term, and There's really nothing about the current setup in the market that would indicate it's a bad idea to be invested at the moment. So I will pause there, turn it back over to Marshall, and I will be around for any questions at the end. Thanks again, everyone.
Thank you, Pat. Appreciate that very much. As always, good information that we can all use, and gives us confidence to keep tuning in and turning on. So we'll get this settled. Let me share my screen again and get everybody back to square one again. Okay. Well, let's get into the economic update itself. And I'll use this slide as sort of a table of contents for what we're going to touch on. But the general economic outlook for Q2 of 2024, of course, the inflation, it's moderate, but it appears a little bit stuck. That last mile that Pat talked about, we'll take a look at that. Geopolitical tensions, of course, the volatility is still there, and we'll be addressing that. You probably weren't aware, but there are some political tensions domestically. Obviously, that was sarcasm, but still volatile. There's all the election turmoil. We've got the tax cuts from 2017 set to expire next year. That's beginning to surface on many of our clients' minds, and we'll be addressing that. The interest rates, well, they're relatively low, but they're on pause. They're stuck. Unemployment's still historically low, but stable, and demand is still high. So, what did happen during this quarter? Chairman Powell said we're headed for a soft landing, and by golly, it looks like he just might pull it off. We're getting closer and closer. So, what does a soft landing mean? A soft landing, under Chairman Powell's definition, is that the short-term Fed funds rate would get up to 5.5. We got in that range. Unemployment would still be less than 5%. We've made that range. Inflation less than 3%. We're right on that cusp. And positive GDP, not a recession. So whatever you call it, growth has slowed, which is generally a bad thing. But in this case, it's the goal of the Fed. The question is, what will growth or lack thereof be like in the remainder of 2024 and beyond? Last year, economists and Federal Reserve officials predicted that the U.S. economy would be sputtering by now. Many people didn't think it was going to sputter. They swore up and down we would be in a true recession by now. The opposite's happening. Recent economic data suggests the economy is decelerating a little bit, but still accelerating despite higher borrowing costs. Chairman Powell says there will be continued growth for the full year. And in a minute, you'll see we've made it through 2 quarters. In multiple statements, Chairman Powell left the door open for future action based on his terms, evolving data received in the coming months. In other words, it looks like it's working, but let's give it a chance. A watchful eye approach. The next meeting dates for the Fed are next week, July 30th and 31st, and then they'll meet again September the 17th. General consensus is that the first interest rate cut would be at the September meeting, and only time will tell. But my personal call, and I think Pat alluded to it from his personal call, I don't expect it next week, but we stay tuned is the only way to describe that. Who knows what's going to happen for sure. So what happened to GDP? And as we always hold these sessions on the last Thursday of the quarter, I do that because GDP comes out at 8:30. And so at 8:30 this morning, we found out that the Q2 2024 GDP was 2.8%. Wow. Talk about being on target. We see the slowdown from the 4.1 to the 3.3 to now the 2.8. This is truly reflecting the Fed goal of, quote, no recession. Consumers spend online for online purchases and, of course, dining and entertainment, but to a lesser amount. The question still remains, what will happen as these savings are being exhausted, the credit cards are being maxed, and the higher interest rates make financing cars, appliances, and other items a little less affordable. Well, if there's a dollar left, the American consumer is going to spend it. I'm not sure anyone anticipated the dramatic level of growth. What's normally good news is met with mixed emotion because it may, and in my opinion, probably will slow the Fed in lowering interest rates. The economy is still okay, so any dramatic changes are just not necessary. Uh, Keep in mind that the Fed is targeting the 3% or below. Inflation for 2022 was 6.5. Inflation 2023 was 3.4. And here we are, inflation for July year to year, July 1st of last year to June 30th was a flat 3. Well, last time I checked, that was the target. So keep in mind again, the FMOC is targeting that 3% or below. But let's look at how that's being accumulated. Inflation continues that slow descent, but here we go. You see the decline, and I'm going to highlight a couple of things that didn't quite come through when I copied the slide. But if you look at the yellow and the gold categories, those represent food and housing. You can see how there hasn't been a dramatic change in those costs. The dramatic change has been in the food and or in the energy sector shifting around a little bit, the insurance and the non-insurance. So you can see other sectors have been hit, but those are so stable and so, oh, unflexible may be the term. So consumers keep the spending there. Well, we have a wonderful situation that I'm glad to bring to you today. Please join me in welcoming our newest member of the firm, Shawn McCabe. For the last few years, Shawn was the director of the CPA Alliance and a partner with CPS Investment Advisors. In that capacity, we were actually his client. During that time, we were able to experience firsthand his commitment to client service. Shawn has joined us as a CPA financial advisor working with small businesses and individuals, and we look forward to having you meet him in person. Shawn, please help us out with our global and economic policies.
All right, great. Thank you, Marshall. As Marshall mentioned, my name is Shawn. I'm a certified public accountant, personal financial specialist, certified financial planner. I've been helping businesses and clients with their finances since 2007. I'm excited to be here. Thanks again, Marshall. I'm thrilled to be part of the Gunn & Company team, and I'm looking forward to meeting and working with all of you. And Pat, also, thanks for being on today and having us. So with that, let's start with some geopolitical tensions. Not much has changed the last few quarters. I've been tuning into Marshall's presentations, and not much moving here, but we'll go touch on a couple of points. The Russian-Ukraine conflict wages on, causing humanitarian issues, creating more risk to investors, capital flow in that region. While world leaders are optimistic the conflict is contained, there's always risk of escalation, increased tensions between Russia, NATO, the West, and surrounding countries. So we're keeping an eye on that for everybody. Additionally, the Hamas-Israel conflict also continues to rage on. There's instability, economic uncertainty in that region with the same risk of escalation in both regions with hopes of peace for peaceful resolution. Don't know if anybody's been paying attention to Wiz as an Israeli company backed out of the deal with Google. I know Pat's been talking about that. Has no impact with Google on their earnings or anything like that. But cool part about that is they may end up going public. So we're going to definitely be keeping an eye on that company, that region, and see what's going on economically. China continues to support their neighbor, Russia, threaten hostilities towards Taiwan. Nothing new there. I know there's some concerns, maybe the chip makers and some technology coming out of there and how that'll impact. So maybe we'll address that in a little bit. What is new? Quasi-new, not really new, but kind of new on the global scale is and showing up on the geopolitical radar are cyber attacks. They are a growing geopolitical risk as these attacks become more sophisticated, effective, increasingly relentless, and world-reaching. They've become a significant threat to businesses and national security. While the CrowdStrike incident last week may not have been a cyber attack, the impacts of an internet blackout were felt globally. It'll be interesting to see how our lawmakers respond, especially those that were hung up in the Delta disaster, if they respond at all to the CrowdStrike blackout and any additional actions taken to thwart cyber threats globally. But I take that as a good reminder for all of us to be prudent, double check on our IT security, our information security, and just take a look around, make sure we're doing all the right things there. So lots of tense areas globally. I suspect that will continue through the remainder of this year and into 2025, regardless of the election. So I can't help but wonder, speaking of election, what our forefathers must be thinking. So zooming into the U.S. political tensions, as of June 28th, 24, the U.S. national debt sits around 34.8 trillion. About 20% of the U.S. debt is held by the U.S., which helps drive where debt is being held, of course. The debt ceiling was suspended until January 1 of 25, effectively kicking the can to the new administration. I'd expect not much change there, especially while the U.S. dollar remains the world's reserve currency. Best we can do is encourage our lawmakers to address it, and we wait and see. Hopefully we know by now, or hopefully we all should know by now, President Biden has stepped aside as the Democratic nominee for the 2024 presidential bid. He's endorsed Vice President Kamala Harris as the Democratic nominee. Kind of sticking to the theme here, we'll wait and see what the Democratic Party will do and who they will select. The Democratic convention is set to take place August 19th through the 22nd. I'm pretty certain all of us know that they'll have a candidate front and center long before then. But again, we'll have to wait and see. Currently, kind of drill a little bit more down into the political tensions. The Democrats control the Senate, 51 to 49. There will be 33 seats of that chamber up for election. The Republicans control the House, 220 to 212. There are 3 seats vacant for those of you doing quick math. It's anyone's guess how control of the House and Senate will fall in November. But the real thing is, what does all that have to do with your portfolios? Directly, nothing. Indirectly, we may see some volatility based on election uncertainties, geopolitical tensions, as mentioned above, or just time. But the reality is policy is much more important and impactful on the companies we own than politics. Probably going to get tired of hearing us say that the rest of this year, but that is resoundingly true, and we hope you hear us on it. But as you can see from the chart above, GDP grows no matter which presidential party is in the White House. The only thing that changes is who takes credit for the momentum started long before each president took office. So here's the deal. If you're a little upset over one candidate or another, which I know there's a lot of us out there who are, take a deep breath. Know that the election will have little impact on your portfolio, probably on your life, and know that in a few months, the dust will settle and we'll be back to business as usual. So speaking of that, be sure to save the date. Marshall and I will be hosting the Elections Over Now What on November 10th this year at 10 a.m. So make sure you save that date. We'll get information out to you, calendar invites and so on and so forth as we get a little closer to that, but go ahead and pencil that in. So speaking of policy, the Tax Cuts and Jobs Act of 2017 brought sweeping but temporary changes to the U.S. tax code. The changes promulgated by the TCJA will expire at the end of 25 if Congress doesn't act. The presidential and congressional elections will be the first tell as to which way TCJA will fall. So what's at stake? Individual income tax brackets increase if TCJA expires. Individual income tax brackets increase from 37 to 39.6. AMT becomes more likely, alternative minimum tax. A lot of the deductible issues we were able to take before won't be able to be taken, and vice versa. Your state and local tax and mortgage deduction caps go back up. It's actually a benefit. The qualified business income deduction is eliminated. So those of you small business owners taking that 20% deduction will no longer be able to do that. And the most resounding and concerning issue is the significant changes that will be made to the gift and estate tax rules. And this is something that Marshall, myself, and the team here will be keeping an extremely close eye on, and we'll be quick to advise all of you what to do as things unfold. For now, though, stay plugged in to what we're doing, and don't hesitate to reach out if you'd like to dive deeper or talk specifics about your situation. To that point, be careful what you read on the internet. It's on an internet, it must be true, right? Well, knowing our legislators must do something about the Tax Cuts and Jobs Act, there's been a lot of hype about trying to speculate on each presidential candidate's tax policy and what may come to pass upon election. One such example making the rounds on the internet is known as Project 2025. In summary, this 922-page document casts a wide net. The writers of the proposal are attempting to revise tax policy and reform oversight bodies such as the SEC to roll back many of their sub-agencies, FINRA, PCAOB, ERISA, and so on, DOL. The document proposes 2 individual income tax brackets, one at 15%, one at 30%, versus the 7 current that exists, a corporate tax rate of 18%, and a capital gain and qualified dividends at 15%. Marshall, I don't know about you, but that sounds awesome, right? Makes our job a lot easier. In addition to those proposed tax rates, it proposes to do away with all tax credits and all deductions. So kind of cleans things up on the tax front, but we'll see what happens, as we've been saying a lot today. While all this does sound great, please allow me to offer a PSA I think all of you will love. You ready for it? For your own safety, please do not read the 922-page Project 2025. Trust us on this one. Even if Project 2025 has support, it would still need to be proposed to the House as a bill, or by the House as a bill, referred to the Ways and Means Committee to agree on all the terms, and then they'll draft a policy to push back to the House, and then it has to make it through Congress, and then the president has to sign off. Can you imagine that a 922-page document making it all the way through there the exact way it is today? Not going to happen. So what I'm saying here is Project 2025 and many other proposals like it have little to no impact on your plan or your portfolios. Once proposals like this raise to levels of impact, you have us to worry about that for you. So I'll end on this note. Until it's policy, it's politics. So Marshall, that's it for me today. Thanks for having me. I'll turn it back over to you. And again, I look forward to meeting everybody and working with you all in the future. And thanks for having me.
Thank you, Shawn. That's great. Welcome to the team. Appreciate the presentation this morning. And obviously there's a lot going on, so none of us will be bored, and I'm sure each of you on the call today will be attentive. As we know, a critical driver of the U.S. borrowing cost, of course, is the 10-year yield, and this has declined to 4.25% from 4.5%. The driver, of course, is the start of the anticipated FOMC rate cuts. Now, near high home prices around the U.S. Continue to make it more difficult for first-time buyers to compete, and interest rates have tripled, of course, since 2021. According to my realtor clients, the biggest hurdle is still supply. Existing homeowners still aren't willing to give up that 2.5% mortgage. Can you blame them? Congruent to the 10-year Treasury, mortgage rates have declined from about 7.5 to 6.75. Demand for mortgages is dismal, but mortgage refinancing is virtually non-existent. I wanted to throw this chart up here for you just so you could take a brief look at it to see, we're getting a sense of direction of what I'll call stabilization of the interest rate. But I'd be the last to predict when that 6.77% that we're seeing as of the other day gets back down to that sub 5 or sub 4. We would hope that would be within a couple of years, but we all know you just never know how long it's going to take for that to happen. Unemployment, help wanted. Ooh, a little bit of a tick up. Employers are continuing to add jobs, but more people are getting back in the workforce. Keep in mind again that the FOMC is targeting anything below 5%. So when we look and we go back to really January of 22 and looking at the adjustments where the Feds have really started hitting the interest rates, we can see that the non-farm payroll, the job additions have come down but have stabilized at around that 200,000 jobs rate every month. The unemployment rate has remained below 4%, teetering in that roughly 3.5 to 4 range. And now it has suddenly ticked up to that 4.1. Ordinarily, we would look at this and go, wow, that's not good. Unemployment's going up. But keep in mind, this is the target of the Feds to edge that up, to slow down the economy. There's so many different factors that come into pulling that off that it just makes it hard to take any one yardstick or measurement and say, hey, this is the one that's winning, and this is proof that things truly are working in that area. You got to have things working in a multiple of areas. But how's the consumer feel about this? Well, consumers are saying they're feeling so-so about the economy. Look at this. It's dropped 10 points since the end of the year. So despite inflation's negative impact on purchasing power and sentiment, consumers, though, are still spending, and that growth is just kind of remarkably resilient. It truly is the YOLO concept of you only live once. Why is this happening? Simple. We go back to the previous slide. Consumers have jobs. When consumers have jobs, they have money. Not as much as they once had, but what they do have, they're spending. This apprehension still hasn't kept Americans from reaching for their credit cards. They're spending their last cash reserves on traveling and enjoying their one life. Leading economic indicators. Well, got a continued decline here. Now, not nearly as dramatic as consumer confidence, but which has obviously dipped substantially more than the leading economic indicators, but we have seen a decline of about 2% since the first of the year. Well, that kind of works into the economic side of the GDP dropping a little bit, unemployment going up a little bit. I mean, all these things are starting to at least be a little bit synchronous. And that, of course, will lead to the Feds reversing their interest rate posture. To kind of look at that graphically, our blue line is the year-over-year change of the leading economic indicators, which in many cases are drawn via consumer sentiment. And then we have the black line, which is real GDP. And as you can see, those usually work in the same direction each other, but can have dramatic differences. For example, you look back in 2008 when the leading economic indicators said basically, hey, y'all, the world's getting ready to come to an end. You might want to give a heads up. And of course, we had the leading economic indicators before that in 2004 going, man, this is fantastic. This rah-rah is going to last forever. They've been pretty synchronous going through since 2010, but now we're suddenly getting a large disparity. So back to the blue line, the indicators are saying things are slowing down, but real GDP is still hanging and being positive. Going to be interesting to see how things wear out in the third and fourth quarters of this year. And will the Fed anticipated rate cut be the key to keep real GDP out of recession land and up in positive growth? I want to mention one other thing that I always talk about, and that's turning off the noise. I was thrilled to find that there was a quote out on the internet. That's where I got this. It says from Abraham Lincoln that tells us don't believe everything you read on the internet. So be careful what you read and what you put your faith in. Stick to reliable sources, and I hope you think of us as one of those reliable sources. We spend a lot of time every quarter trying to find accurate information to keep you well informed. So what about investing in uncertain times? You see this chart just about every quarter from me. The bull market trend continues. Are we due for a correction? Absolutely. Keep in mind, corrections of decline are 10% or more, but less than 20. They're completely natural. That's why this isn't totally linear. You see the little dips and undulations in the chart. Headlines keep touting all-time highs, and up until the last couple of days, it seemed like that was a daily occurrence. Should we wait until the market cools and invest excess cash? Well, Pat showed us the chart about, well, that doesn't really pay off for you. It might pay off over the next 3 months, but if you're a long-term investor, that's not the case. So when is a good time to invest in the stock market? The key word there is invest, not speculate. In the short term, anything can happen. Chairman Powell could sneeze, but the long term, being an investor, the chart speaks for itself. Please note that returns have historically been slightly better when investing at new highs, that new momentum that Pat alluded to earlier in the presentation. So what do you focus on? Well, very simple. Financial independence and security for our families when we are living and of course, when we're not. So stick to sound economics, Financial planning never goes out of style. Stick to the basics. And since we're coming up on football season again, I'll resort back to one of my favorite coaches. Not that I'm an FSU fan, but Bobby Bowden used to always come back to it. All comes back to blocking and tackling. Well, a good solid financial plan always comes back to the basics and looking at sound investing and economic approach. That's the ones that pays off for you in the long time. Well, if any of you have any questions, I would like for you to go ahead, drop those in the chat box. We've had some in advance. Pat, I want to send this first one to you, if I may. And basically, it's with higher current interest rates, has CPS changed their asset allocation recommendations?
Great question, Marshall. Short answer is no, and I'll elaborate on that. I think the question stems from higher interest rates. Should we be looking at trying to get more income? And where I boil this down to is your own financial plan. So to answer that question, as an overall investor, no, I believe in owning profitable, growing businesses for the long term. But I would recommend sitting down with you and Shawn and talking about individual situations, for the sole fact that interest rates are more attractive on fixed income than they have been in 15 years. So if you desire or require income from your portfolio, you would just need to talk to your advisor about the type of risk you need to take to achieve your goals, not the risk that you're willing to take or that you should take, but what do you need to do to achieve your financial goals? And if that means you need a little more income generating assets, then that can be done. If it means you're willing to take a little more risk and search for growth, that's still the best option for you over the long term.
Thank you, Pat. Shawn, got one that I think you started on a little bit, but let me ask you to follow up here. How will proposed or intimated regulations, we keep hearing a lot about regulations, by either, well, I'm going to be nice and say Harris or Trump. The question actually had Biden in it because it was written probably 3 days ago. But how will those regulations by the Democratic or Republican administrations stifle AI stock growth due to trade limitations with Taiwan? That's a good one. I'm glad you're my international guy.
Yeah, right. Marshall, that is an interesting question. My audio coming through okay?
You're looking good.
Okay, good. Well, I think to that point, I think trade limitations always have a potential to stifle trade. That's the point. Historically, though, I think good companies, especially in the global economy that we get to experience right now, always find a way to drive profit, make a profit. Kind of that being said, though, I think I mentioned it earlier, and I know you guys talked about it too, but we have to be careful making decisions early based on proposed policy. And it's funny, I'm kind of internally laughing about Biden versus Harris. Technically, the Democratic National Convention has not picked their candidate yet, Marshall. So just being careful for all of us not to get too excited about headlines and potential legislation that has to go through a lot of hands before it's made into policy. And again, I promised you will hear this a lot from us this year. It is policy that's most important, not politics. So at this point, I still think we're on the politics side of things. I think to drill down a little bit further on the AI semiconductor play, I think it's a fair, not too big of a stretch to go there with it. You have to know what you own. So if you're making that AI play, sure, whatever AI play that is and what you're taking there, that play can withstand those trade restrictions. Say you have a Taiwanese company, and I know a lot of investors out there, not an official recommendation, hold NVIDIA. It's part of the Mag 7, as Pat calls it, and well known as that now. Can it withstand trade restrictions? NVIDIA does have a presence in Taiwan. There's another Taiwanese semiconductor company out there a lot of people look at on the trade side. But at the end of the day, it really does boil down to owning good quality companies. I know you hear you say that a lot. And those companies find a way to make profit. So maybe an indirect answer there. It is a good question, but again, it's a wait and see kind of thing. And I wouldn't make any moves in your portfolio or worry or concern about it right now until things settle down. And then with that, I'll leave it on this. I think your AI semiconductors have a lot of momentum behind them. So even with the trade restrictions, I think we'll be fine.
Hey, Pat, I've got one. Thank you for Sean for your answer, but Pat, hey, I've got one for you. Since I use a crystal ball, this particular attendee wrote in reading the tea leaves. So I know you like to drink tea, so you can read the tea leaves on this one. How might the upcoming election affect the market? And since we touched on that a little bit, let me give you the two part of this question. Or what other mitigating factors do we expect will impact the market in Q3 and Q4?
Great question. And so I think we've hit on them here. We're talking about the election. Obviously, that can have an impact in the short term on the market. But I believe your graph and the things that we've shown previously illustrate that long term, it really doesn't matter. So 5, 6 years from now, today's election won't matter too much in terms of the market. In the next couple of quarters, I think one side wins, you increase the likelihood of tax cuts being extended, and the market's going to love that. If another side wins, it really comes down to what parts of the tax code remain in place and how that changes. So I would expect fireworks through the election if I have to be, looking at my crystal ball. The market's been not as volatile as usual as of late, and I think the election is the perfect recipe to have it go up and down. The market overreacts in the short term to just about anything it wants to. The election is certainly going to be one of those items. That being said, I saw the statistic this morning, and I'll just share it with you. In cases where we've had an incumbent running for re-election, the market has never finished down in that year. Now, our circumstance today, as of late, is a little different. We don't technically have an incumbent running again for re-election, but we had that up until recently. And why is that important? It's important because what does the incumbent administration do when they're running for re-election? Well, they typically juice the economy. They pass some spending bills, they spend a lot of money, and they do that in the year prior. And I mean, this recipe is adding up to what we've seen over the last couple of years. By the time all that money trickles into the economy, people are feeling good. They're spending their money, as you've illustrated for us, Marshall. That has taken place. So the same effects of an incumbent running for re-election have come to pass. So economically speaking, it's as if he was running for re-election again. And Sean mentioned we'll see who the candidate is and how that administration plans to run things moving forward. But history does show us that in this scenario, the market still ends up higher for the year. Will it be as high as it is today and these all-time highs? That's hard to predict, really. Are there other circumstances that could affect the market outside of the election? Certainly the geopolitical side, as you guys have done a great job covering. So it's that existential item that comes up, that COVID, that breakout of another conflict somewhere, or escalation of one of those global conflicts, and then simply economic numbers. If they take a turn for the worse dramatically, those are probably the biggest candidates for market turmoil. But tea leaves are telling me I still think we'll have a strong end to the year, and really what policies we see moving forward are going to be a driver for 2025.
Thanks, Pat. You can go back to drinking your tea instead of reading the leaves in the bottom of the cup. That'll be great. I'm going to take the next one. What's the future of digital currency? And as I'm sitting here looking at the screen, you see this smiling young lady who is the expert that we have. That's my 2.5-year-old granddaughter, Aaliyah. And Aaliyah would be more than happy to take your digital currency off your hands because it's obviously a terrible thing, but she will accept it on your behalf. She has no clue what it is, but I'm sure she'd love to have it. The reality is digital currency is going to remain a question mark until we can finally get it regulated. It's kind of a free frontier out there at the moment, but I think once the SEC, the IRS, the banking system can get a grip on it, I think you will see digital currency get stronger in the future. Now, that is not a recommendation to buy or sell, it's just the concept of digital currency. And like the dollar, like the yuan, like the yen, its value will vary from time to time based on perception. There's nothing to support the value other than the perception that this is what it's worth. So in the interim, if you've got digital currency, by all means, give it to Aaliyah. She'll take care of it for you. You can purge yourself of that concern of what's going to happen with it. But the reality is nobody really knows because it's just not a factor of day-to-day society, the day-to-day economy. Pat, I'm going to wear you out today. I got another one to kick back to you. What's the potential for AI stocks to crash or maintain?
Great question. I think Shawn made a great point that they do have a lot of momentum this year, and momentum does drive in the short term. However, leading up to yesterday, or what happened yesterday, you saw that Mag 7, I think, drop by about 6% in value overall. So when you look at a $1 trillion company, for it to drop by 6%, quick math, I think we're in the $60 billion neighborhood there. Shawn will check me on that. But that's the value of a lot of regular sized businesses out there in the market. So why would they change so dramatically in a single day? It's because of the hype around the AI idea. But outside of the short term, one concept I keep going back to is all the money that's being spent on AI. At this point in 2024, it's hundreds of billions of dollars have been dedicated towards chips, towards investment in infrastructure and things of that nature. At one point or another, these companies that are spending the money are going to have to reap the reward. So they need to be able to generate revenue from their AI initiatives. So you look at things like, really what the consumer can do with AI. You're looking at the iPhones coming out. You're looking at what are actual businesses doing to generate revenue from this spending in AI. And if that doesn't start to come to fruition in the near term, I think you're going to see the hype behind it, not necessarily crater or crash, if you will, but slow down a little bit. Long term, the market relies on fundamentals. Earnings are important. And if you're spending a lot of money and not creating a lot of earnings behind it, investors are going to start to worry about that. That's what I'm watching, is who in the AI space is actually going to generate revenue from their AI initiatives. And I think that'll tell you who's most likely to stay the course and who's most likely to see their valuations come back to earth.
Thanks, Pat. I'm going to follow up that just a little bit, that one of the biggest challenges with AI is the education of the user. It's a new concept, and having that user learn, wow, I can do this. And I can just ask each and every one of you to think back to 20 years ago and what you do on your phone today that you didn't do 20 years ago. What will the AI generate that we will want to do as a consumer on our phone in the next 5 to 10 years? That's going to be the driver as well. Thank you, Pat. Shawn, back to the political scene for you. And I'm not sure whether this particular participant is a Democrat or Republican, but their question was, how will the election of the Republican candidate affect our investment?
I love that question, Marshall. Thanks for bringing that one back to me. I think Pat nailed that one. I think the reality of the election will be fireworks leading into the election. I think there'll be some short-term volatility. And I think the fourth time saying it today, it will more or less fall on the policy that gets through than the politics. So really, it's going to be the volatility leading into it. Longer term, and I'm talking 5-10 years out, it doesn't matter. So intermediate term really does boil down to where policy lands. I'm talking about the Republican candidate. Pat mentioned that earlier. That side does support potentially keeping the Tax Cuts and Jobs Act in place as is, a little bit of reform there, but potentially making those tax savings and tax changes and tax reforms permanent. Not sure on the Democratic side what's coming out of that from the policy standpoint. Pat did allude to that there are pieces of it that are bipartisan, that both sides support, because it does support the U.S. economy in a lot of ways. So kind of no good answer other than long term, it doesn't matter. Short term, it's going to be volatile. And intermediate term, we're going to keep an eye on policy and watch what happens. Just a friendly reminder one more time, it boils back down to the good quality investments that you own, the fundamental research that Pat and his team, Marshall and I do, making sure that those investments fit the financial plan, because we know good quality companies, getting back to the chip makers earlier, will find a way to continue making profit, regardless of what policy, what tariffs, what trade restrictions, what's going on in the overall global economy. So I would say prepare for volatility. Doesn't matter who gets elected. We'll be here to help manage you through that. And then we'll keep an eye on policy. That's what we do.
Thanks, Shawn. Appreciate it. I've got one today that's not really in investing as much or even the quarter, but it's one that so many of our participants are Florida residents. And so the question uh, that comes to mind very simply uh, excuse me one second, let me get back to the sharing of the screen. Yeah, we've got it. Um, we're considering canceling our homeowners insurance after it has doubled in price this year. We own our house, no mortgage. What's your opinion? Well, my opinion is be glad you're not here in Florida because doubling might have been gracious. What we have obviously seen in recent months or the last couple of years here in Florida is no longer a doubling, but in some cases a tripling and quadrupling. So very challenging. But let me talk about homeowners insurance in general and just say, like any insurance, the intent of homeowners is just simply to mitigate the risk of loss or damage to your home. It's very simple. So to just give you some quick math, that if you have I'll use a $500,000 home just because the math gets really easy, and your annual home mortgage premium was $5,000, you're betting 1% a year that something might happen to your house. And you might bet that, let's say that you have 20 years of life expectancy left. So at $5,000 a year for 20 years, you would have paid $100,000 in premium, but the intent was to protect a $500,000 asset. And hopefully over the 20 years, that $500,000 asset would have increased. So while none of us like our homeowners insurance increasing, I encourage you to go back, look at your policy, see if you couldn't raise your deductible or if you've got some coverages that you feel you just don't really need, and shop it, of course. But I wouldn't give it up in its entirety, especially if you're a Florida resident, because knock on wood, we were very graced in getting through the first 2 months of hurricane season, but we all know we have 4 to go and anything can happen. So I wouldn't run totally exposed, even though your home is paid for, without some version of homeowners insurance. And keep in mind, a part of that homeowners insurance is always the liability coverage as well, in case someone should slip and fall at your house and hire a law firm with 2 names. We see all the ads for those on TV constantly, and litigation is a big part of our world. So to begin to wrap up, remember the next few months could be very volatile. We don't know who will occupy in the White House. I'd almost like to throw, if anybody would bet $20 on any candidate to win, please step up in the chat box. I'm not exactly sure how that's going to wind up, but as we know, that over the long term, again, it's policy, not politics. Shawn told you you're going to hear that a lot, that drive the economy, and the economy drives the market. So it isn't as much about who lives in the White House, but how are the House, Senate, and White House controlled. Our forefathers were smart and they developed what was referred to, or what is referred to, as the balance of power. Not much will get accomplished on the policy side if we have a balance of power, but there'll be lots of politics to scare us and scare the market. So always build your investment portfolio with companies whose profits are not tied to politics. Regardless of who's in the White House, people will continue using their Charmin, eating, taking their drugs, and using that cell phone. So we know those are absolutes. So to close, I don't see any more questions in the chat box. If anyone wants to throw one in as last second, let me know. If you know someone who would benefit from our webinar, we will also be offering the recording of today's presentation on the Gunn & Company YouTube channel. Once it's posted, we will email a link to all of those who registered. As always, feel free to share it with your friends and family. I don't see any final questions, so our next scheduled event will be the annual economic update on Thursday, October 31st at 10 a.m. We promise, we know what day that is, so there will be no tricks and hopefully some treats. And as Shawn mentioned, we'll be scheduling the event for Thursday, November 14th at 10 a.m. The election is over. He and I are really hoping the election's over, as we know that hasn't always been the case. But the election's over. What do we do now? We're hopeful that that will be the case, so keep your fingers crossed. I'm certain the next 3 months will be interesting. Thank you for joining us. Thank you for allowing us to serve you. And we look forward to meeting with you soon. Take care and stay safe.